Great. So welcome everybody. Welcome to the Crowdfunding Professional Association webinar on the topic of side-by-side offerings. Can Reg CF work alongside other capital raising paths? So we're pleased to have everyone here. We also are streaming live on SuperCrowd TV. And so thanks to our partner, the SuperCrowd, for doing that. We are going to talk a little bit about the mandate and role of CfPA, and then we're going to get into the substance of the discussion today. And we have two great panelists we're very excited to share. This is a topic that we get a lot of questions on from people in the industry, from people who are prospective issuers. So we're really excited to get into the substance of this with the crowd, with the groups we have, the panelists we have today. So before we do that, I'm going to chat a little bit about some CfPA items. So let me share my slide here just to give you, for those who are unfamiliar with CfPA, it is the Crowdfunding Professional Association. Is really the trade association. It's a nonprofit trade association that represents really the whole ecosystem involved with regulated investment crowdfunding. That's everyone from portals to accountants to lawyers to analytical companies to just everybody who's there. We have membership that is inclusive of all of them, and so we really work to promote the best interests of the industry. We advocate, we educate, and we advance the industry in to various formats. So we are going to have a big summit every year. That's one thing that the association hosts. It's in Washington, D.C. It'll be October 20 and 21st. This is an event where people come in from all over the country. They fly in, and day one, October 20th, is time where we spend time with the legislators or regulators. So people are up on the Hill or meeting with the regulators to talk about sort of the most relevant issues of the day. That evening on the 21st, there's a welcome reception. Day two of the event is mainly a conference where there's a lot of panel speakers. Really, you're going to have some of the best and the brightest who are working in the industry together, sharing best practices, talking about the latest events, or talking about the latest developments, working to really look and sort of collaborate on how to, again, advance the industry. It's also held at the same time as DC Startup Week. So for those of you who are interested in meeting lots of startups, are going to be all around town at various events. It's nice that we can bring the crowdfunding perspective to the town at that time so that the VCs aren't getting all the attention that week. So that is October 2021st. We encourage people to sign up. You can go to ricsummit.org as a place to sign up for that. And we hope that you'll be able to join us for that. We also, as an organization, have a couple sites online where you can come and learn more about CfPA. There's cfpa.org, and there's the crowdfundingecosystem.org, which is the online community of the association. So you can go to either place to learn more, to engage if you're not able to make it to DC, or if you want to engage with people prior to the event. If you'd like to join as an individual or corporate member of the organization, it's very reasonably priced. We'll share the link here in the chat in a second. It's an opportunity to network, to learn, to share best practices in the industry. And if you join as a member, you can join one of the operating committees that we have. We have committees that focus on issues such as policy or intermediaries or growth marketing or just various topics we're covered in the various committees. Really roll up your sleeves and have discussion with other folks in the industry. So we'd encourage everyone to sign up and join and to engage with us as an organization. So with that, I'd also mention that next week we have an event that we're doing with our partner organization, the SuperCrowd 26. Our SuperCrowd 26 is a big virtual event or a remote event that's online, and you can come and learn more about that at supercrowd26.com. A lot of great people in the industries who are going to be there. A lot of people here will be speaking, so we look forward to hopefully having and meeting some of you there in advance of the summit. And for those who can't make the summit, this is a great place to, again, meet people. So with that, I've done housekeeping. So let me turn attention to our panelists. We are honored today to have two very distinguished individuals who are experts in the field of capital raising and capital formation. They have bring a wealth of experience. They have a lot of great ideas that something they have expertise that we all can learn from. So first, I'm going to introduce Sean O'Reilly. Sean is the co-founder and CEO of New Columbia Capital, where he helps early stage founders navigate fundraising, growth, and strategic challenges. He specializes in connecting visionary entrepreneurs with investors through innovative private market strategies, and he's passionate about helping the next generation of entrepreneurs turn bold ideas into successful ventures. So, Sean, why don't you say hello and tell us how you found this passion?
Yeah, I couldn't have said it better myself. Thank you, Brian. Thank you to the rest of the CfPA team. Yeah, I first got involved in the crowdfunding market in 2018 when I was the first employee at King's Crowd, the data markets provider, and fell in love with it. I love being helping a startup grow. I love the concept of the markets of allowing anyone to invest in a early stage company. But I also saw firsthand how hard it is to raise money when you're a founder. You have a full-time job already, which is running the company. And so really wanted to parlay that passion for helping founders, basically run their companies while raising money. And that's what we've focused on specializing in here at New Columbia Capital.
Great. Thank you, Sean. So Marty is our next panelist. Marty is a securities attorney and he's a partner at Massey, Bean and Lewis. He has 26 plus years of experience. We may say nearly 30 years here, Marty. So nearly 30 years of experience advising clients on crowdfunding, digital assets, blockchain, fintech, private equity, fund formation, and securities offering. He also advises clients on structured finance, investment advisory, real estate, asset-backed lending, securitization, lease financing, and M&A. Marty, you don't look like you have almost 30 years of experience, but why don't you go ahead and tell us how this particular sector became your passion?
Yeah, just really good filters, I guess. So I got involved in, I had my first sort of crowdfunding client before the Jobs Act. We were trying to figure out like how to do uh, basically peer-to-peer payday lending. And as we were working through that, I was introduced to the people that were working on the Jobs Act, got involved with that. And it's been something I've been involved with since Jobs Act was passed, since the regulations came out. I've known a lot of these people in this industry for a very long time, and it's something I really enjoy. It's had different turns that it's taken over the past decade plus, and with different things becoming hot topics, but we've kind of moved ahead, and it's been just great seeing the industry grow and the success that it's had. So I've
So,
been
so
happy to be a part of it.
yeah, thank you for joining us, Marty. And we're not going to call you an old timer because again, the filter works well. But you clearly have a lot of experience, and everyone can benefit from that. This is going to be a broad audience who's participating. There'll be some people who, for the first time, are hearing about some of the terms affiliated with crowdfunding. Reg CF, which is a big part of the focus of our association, is really just one of what the SEC calls sort of a patchwork of exemptions. And so let's start off with just sort of, exemption offering 101, keep it simple for people who are joining us and then we'll get into more nitty gritty very quickly. So before we get into the concept of side by side, Marty, we'll start with you with a few legal questions to give people some foundation. So can you help us understand what is an exempt offering and why does a company need this when they're raising capital?
Yeah, so it's a great question. Anytime a company is raising capital through selling securities, so whether that's they're selling equity, they're selling debt, they're issuing a SAFE, a SAFT, tokens, um, they either that is a securities offering, and that securities offering either needs to be registered, meaning you're registering with the SEC and you're being approved by the SEC, or it has to fall under one of many available exemptions from registration. And there are both federal exemptions and each state has their own exemptions as well. We talk pretty broadly, and when we talk about exemptions, we mostly refer to federal exemptions. However, like I said, there are state exemptions as well that that people sometimes use without even knowing. So if you sell to a, if you're a startup and you get some seed capital from your father-in-law and your neighbor, you're selling securities. And luckily, there's probably an exemption out there that you would fall under that you didn't even know you met. So, but that's something to think about. Anytime you sell securities, and the broader and the more people you're trying to talk to, and the more money you're raising, the more it's incumbent upon really understanding what exemption you're falling under and what you need to do to comply with that exemption.
So thank you. When we talk in the field of regulated investment crowdfunding, there's a couple terms that pop up a lot. One is the term of general solicitation, and second is that of accredited investor. So let's start with the first, and I'll stay with you, Marty, because this is, we're giving everyone a legal foundation. So we'll get to you in a minute, Sean. So Marty, general solicitation, what is it and why does it matter so much in exempt offerings?
General solicitation is just a really fancy word for advertising. General solicitation can take place or can happen in any number of ways. I mean, traditionally, that meant you were putting an ad in a newspaper or doing something on the radio or television, or even holding a conference and bringing a lot of people together and talking to them and trying to raise capital from that people. That's traditionally what general solicitation meant. It's really what it means now is using the internet. Are you using the internet? Are you to raise capital? So if you have a web page, a website that says, invest here, or we're raising money, contact us and find out how. That's a general solicitation. If you're sending out mass emails, if you're putting something on social media, on, all of that would constitute a general solicitation.
So that's great. I think that that's something that many people don't realize, especially when people you see, if you just casually going through social media posts and you see someone say, "Hey, we're raising money," and pitching, they may not realize, that in and of itself is a general solicitation. Is that correct,
Yeah.
Marty? Yeah.
Yes.
So
And that means, yeah, then that triggers all sorts of things.
triggers all sorts of things. So now on the other side, the other piece concept that's important for us to establish the baseline is that of what is an accredited investor. Can you talk a little bit about that for everyone?
Yeah. So an accredited investor is, it's a definition under 501, under the Securities Act. If it's relevant what
You don't have to give
section.
us the specifics, just yeah, generally speaking. So
What date was
Yeah.
it published on? No.
Yeah,
so
exactly. And it's really a way to categorize a certain class of investors. Um, the reason for that is they're presumed that this class of accredited investors is knowledgeable or can bear the risk of an investment. And so you hear that term accredited investor all the time in connection with these exemptions. Um, just loosely, an accredited investor is an individual that has over $1 million net worth, and that excludes their primary residence, or an annual income of over 200,000 individually, 300,000 with their spouse. They can also qualify by having certain securities licenses, by being a company insider, like an officer director of the issuer, or a knowledgeable employee of the issuer. Or entities can qualify by having over $5 million in assets or investments. Like I said, the reason this matters is because certain exemptions only allow accredited investors,
okay.
or other exemptions allow non-accredited investors, but there are caps on how much they can invest. So there is this distinction, and it's really in connection with almost every offering between accredited and non-accredited investors, and what they can and can't do, or if they can participate or not.
Okay, thank you for giving us this sort of baseline, Marty. So we have this framework to look at these exemptions. Let me turn attention to Sean for a little bit. So, Sean, you work with issuers. Now, for those who are not familiar, issuers are the people who are raising money, who are out to raise money. So,
Startups. Yeah.
startups, founders, established companies, just those are the ones who. So, from your perspective, from your experience, do these companies really understand sort of these concepts when they start out?
Yeah, in my experience, most founders that come to us have a very basic understanding, if any. They'll think raising money is raising money. That's it. And at the end of the day, it's not malicious or anything thinking that. It's just they're focused on the business case of how much do I need to raise and not the regulatory framework. They're in the trenches with their team. Of course, that changes pretty quickly once they start raising. I would say the biggest surprises usually fall into a few buckets. First is, of course, the general solicitation piece. Some founders, I mean, they might think, oh, if I tweet about my raise, that's just marketing and it's fine. Like I'm just marketing my company. And the SEC sees things a little differently. Twitter, LinkedIn, a press release, talking to your buddy, talking to a stranger at the country club, like podcast appearances, like that can all constitute general solicitation. And that automatically disqualify certain paths for fundraising. They also don't seem to realize that choosing an exemption early locks them into communication constraints. We understand, of course, that a lot of early stage founders want maximum visibility, but most exemptions don't allow it unless you've chosen that path explicitly when it's permitted. Second, of course, the accredited investor definition. A lot of founders that we meet with, they'll just think rich people are rich people. I don't need to worry about it, and that's not true at all either. There are actual thresholds, as Marty said, 200,000 in income or $1 million in net worth, or of course taking a exam. That's more of a recent thing. And they also don't understand that we have to verify accreditation if they go with a 506C, for example, which we'll get into later, or that maybe mixing accredited and non-accredited investors opens up to a ton of complexity that they might want to avoid. Um, Third bucket, I'd say, is this is where it gets real. They don't grasp that the exemption choice constrains their entire raise strategy. And so my advice is always pick your capital goal first, be honest about it, and then identify your investor base. Like, do you have a bunch of wealthy people that you actually already know? In which case, maybe a 506B would be appropriate. And then and only then do you, once you've been honest with yourself about your goals and who you already know and who your ideal network is, then do you match it to an exemption.
Right, that's very helpful. And you've thrown out a few acronyms already, and so I'm going to share with everyone a link, and this is a chart that's provided by the SEC on the various exemptive pathways. And so as we get into some of this discussion, this might be helpful. If you look at it on the left-hand side of this chart, it really talks about some of the acronyms that you guys have already started mentioning. So Reg CF, Reg D, Regulation A as different possibilities. What I will say is interesting is that just yesterday, the SEC released their draft of something called Regulation Crypto. So there's all these sort of
Was that on
exemptions
your
that
bingo card? No.
it wasn't, and that's not on the SEC's chart yet. So the patchwork they have that I'm sharing you the link is what exists today, and then there may be a new one that appears sometime after comments and voting, and it's just something that could pop up in 2027 when there could be a new row on this chart of regulation crypto. But for now, we're dealing with the ones that we know of, and so Marty, turn to you. Can you just talk at a high level? We don't have time to get on the detail of all the attributes of the different exemptions. Can you just talk at a high level, sort of what the key differences are between some of these exemptive frameworks and the acronyms that we've been throwing around?
Yeah, sure. And I'll talk about the kind of the three key crowdfunding exemptions, because I think that's what obviously that's why we're here, right?
Mhm.
So there's regulation crowdfunding or regulation CF, and that allows issuers, so companies, to raise up to $5 million through that offering. It does allow general solicitation, so you can advertise, you can market it, you can use Sean to help you with all of that.
And
The
that's an annual limit, right, Marty?
Yeah, annual limit,
The
5
5 million.
million. Yeah, and all of these limits they'll kind of throw out are annual.
Mhm.
So it's open to everyone. The kind of the key with that is you must use an intermediary, meaning a funding, like a licensed funding portal or broker dealer to sell, to do that offering, to conduct that offering. But again, it's open to everyone. And that's what, when people think of crowdfunding, a lot of times people will go to that. But there's also Regulation D, which allows issuers to raise an unlimited amount. So there's no caps on it. And this is actually the still continues to be the most used exemption. 506B, which is not necessarily a crowdfunding exemption, but it allows you to include up to 35 non-accredited investors and an unlimited accredited investors. And those accredited investors can self-certify that they're accredited. But there is no general solicitation. So some people have tried to do this with having like a basically a Chinese wall that you have to, get in through, and you have to, there's qualifications to have a 506B, and you have to establish a pre-existing relationship and all those things. And that's can be difficult, as Sean referenced. And then there's 506C, which is the more common crowdfunding exemption. And this also allows general solicitation, so you can market it in whatever way you want. Unlimited amount, unlimited number of investors, subject to some other rules that come into play. But this is only for verified accredited investors. So you can only bring in accredited investors, and those accredited investors actually have to be verified by the company that they are accredited. So that sometimes can
So
add
no
some.
self-certification by the investor. The company itself has to go through a verification process with this.
Correct.
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 Okay.
And then the final one is Regulation A. And Regulation A allows issuers to raise up to $75 million a year. It allows general solicitation. It's open to accredited and non-accredited investors, subject to some limitations on the amount that investors can invest if they're not accredited. And a benefit of this is the securities that you sell through this offering are unrestricted, meaning there's no restrictions on secondary trading. So you can theoretically immediately go out and resell the stock whatever the securities that you bought. And I say theoretically because there would have to be a secondary market and platform and so forth that enabled that. The catch to Reg A is it does require qualification by the SEC. So there's a process that you have to go through of qualifying that offering, meaning it's reviewed by the SEC. They have questions. You have to have certain types of financials, and so it's a lengthier and more costly process. But to me, I think it ultimately checks all the boxes if you have the ability to go through that.
And with Reg CF, the earlier one, you just have to file Form C and then use an
Correct.
intermediary and you're good to go. Whereas the
Yeah.
SEC doesn't have to qualify, review, whereas Reg A, it's a more burdensome process up front to get going. So, okay,
Yeah, and
great.
Reg D is kind of the same thing. You just have to, prepare some sort of offering disclosures and file a Form D after you've started, but there's no qualification process either.
Right. Thank you. And so Sean, you sort of alluded this earlier, but when an issue is choosing among these various paths, sort of what are the business drivers, considerations that's helping them make the decision about, it's like, because it sounds like once you're going down a path, you're staying down that path, right? So
For sure. Yeah. We like to advise our issuers to think about it in layers, if you will. So, I mean, at the end of the day, you're always answering the question, who do I want to raise from? How much do I want to raise? How fast do I want to raise it? can I afford the legal and compliance costs? Do I care about marketing visibility? A couple scenarios might be, Reg CF, for example, would make the most sense if you have a compelling narrative and you want to build a community. You get to raise up to $5 million, which is very respectable. But your investors will be smaller check sizes, typically anywhere from $100 to up to, it's 5,000 would be typical. But you do, at the end of the day, want to use marketing, videos, social media content, press coverage to drive investment momentum. And Reg CF is, as Ryan mentioned, it explicitly allows general solicitation. You can kind of double dip in advertising not only your company and your product, but also the investment opportunity, and it's all there. And it is, it's meant to be easier for early stage founders. You file on a platform, there's a public comment period, and ideally you get momentum. Costs are typically lower than a 506B or, of course, a Reg A. The only real downside that should enter into people's calculus is it does take time. You get a minimum 21-day offering period for plus platform review, and the checks are often smaller. And a lot of times, if you're in a hurry, you don't have the time and ability to invest in a successful raise. 506B is, of course, your typical private placement. You're raising larger checks from accredited, sophisticated investors that you already know, typically, and you cannot do general solicitation beforehand. So it's basically people that are in your own network. If you're like a real estate developer or a late stage company with you already have institutional relationships like that, this is kind of your lane is the 506B. C flips that. You can advertise and use general solicitation, but all investors must be accredited, and you need to verify them after they've invested. There's a couple of different methods. I don't know that we'll have time to get into that, but you do have to verify it, as everybody here said. Reg A's, it's basically, what do we call it? A baby IPO, right? Like you're basically a public company, like in baby form.
And I've heard people push back and say it's actually an IPO, it's just not as the term IPO is traditionally used. So, like you say, you are a public offering at that point. So
you might not be listed on the New York Stock Exchange just yet, but it is you're going for $75 million. This is a lot of money any way you slice it, and there are lots of filing requirements and hurdles. You do need to be qualified by the SEC before you go live. Like all that happens. The last thing I'd add here, and again, how issuers might be thinking about this is it does throw people that Reg CF issuers come out and they think their raise will be fast. And I'm hitting on this point again because the reality is the 21-day minimum offering period plus marketing ramp up means you're looking at a longer than might be ideal if you're a cash-strapped startup. And so being thoughtful and honest with yourself as to what you're willing to invest would also enter into which path you choose.
Mm-hmm. So, Sean, let's stay with you. Why would an issuer decide to mix and use more than one exemption at a time?
Raise more money. No, I'm kidding. This is where it gets strategic. A lot of cases, like I'll just walk you through a couple of cases that we'll see. So first is you want to hit different investor buckets simultaneously. So let's say you're a company and you want to raise $3 million total. They'll do a Reg CF to raise, from retail and angel investors, and maybe cap that at 1.5 million or 1.235 million might be more common. But they want to build a community, but they want to maintain control, voting control of their company. But at the same time, they want to raise a 506C raise because, again, our goal was $3 million. We really want to do 1.5 from our community because that's all we think we can raise at average investment amounts. And so you'll do a 506C to target institutional accredited investors and their existing LP base. And those are completely different conversations. And they'll just be happening in parallel. Sorry. You might do a Reg CF first to validate demand, just to kind of build momentum and a proof of concept from people that know you best, your customers. And then layer on a 506C for serious money later on. The other thing is, you're just speaking about the strategy, is just overall visibility. I mentioned this earlier, but Reg CF gives you marketing oxygen because not only are you, advertising your raise within the rules, but you're also, again, advertising your product, your company, and your story gets out there. You get press, you're on a platform that gets traffic just automatically. Tons of people visit wefunder.com every day, for example. Like that adds up and that matters if you're looking for publicity for your company in general. Reg CF does have the $5 million cap. So, of course, if you're going for more than $5 million, you will need to look into something like a 506C. What else? Fourth, I would say basically looking at different investor types and different mechanics. Some folks have no problem investing directly on a WeFunder campaign page. Some people are old school, prefer to mail you a check in the mail, and you got to verify that they're a accredited investor. So different strokes for different folks there. And the other thing, people sometimes this happens more than people admit, but they'll be hedging. And there's nothing wrong with that. You're hedging. You want to launch the Reg CF. Hopefully, it gets traction. You're doing everything right. You're posting press releases. You're doing podcasts. But maybe it doesn't take off. Maybe you do need to get that $1 million, $2 million before the end of the year, where your burn runs out. In which case, you probably should be talking to a few institutional investors as well. In which case, doing a side by side is also a great move.
So you mentioned a number in there, 1.235 million do you or Marty maybe want to explain why that's significant?
Yeah, that's just the amount. If you raise more than that and it's your on your first offering, you trigger the requirement to have audited financials. So there's some things that happen there because getting an audit can be time consuming and expensive. So sometimes people will play with that number a little bit and say, hey, we're going to stay underneath that. We don't need audited financials. We can either have, certified or reviewed financials underneath that. And so we'll funnel some investors into the Reg CF, and then we'll have other investors that are accredited that we're doing in the 506C offering. So that way we stay underneath that cap. Yeah, there's definitely some games that can be played there.
People are that goes into the consideration in terms of raise strategy
Mhm.
is one of the things I think both of you are
Big time.
big time.
Yeah.
So legally, before people decide on a particular using a particular exemption, what do they need to understand, Marty? Let's stay with you on
So
that.
I think there's some key things to understand. One is this legal concept of integration, which is basically the SEC will look at if you're doing one or more offering, they will look and say, hey, are these basically the same offerings? This used to come into play more with like sequential offerings where people would do an offering and they would stop and then they would do another offering, and they said those are basically the same thing because they were trying to stay under like the 35 accredited investor cap for a 506B. So sometimes you have to look at that, like, are these offerings is basically the same thing and should they be integrated? The other thing is just communication. I think it's because certain offerings allow general solicitation and other offerings don't. You get into this problem all the time. Like a lot of times people will say, hey, and Sean kind of referenced this, like you've got somebody that says they're doing a Reg CF or they're testing the waters, and they're all of a sudden their buddy shows up and says, hey, or my neighbor says, hey, I want to write a check. I want to invest. Well, because that web page is out there, because you're marketing that Reg CF, it is presumed, even if that person doesn't even have the internet, never seen the internet, never seen the website, doesn't know anything about it, just talk to you and says, I like this, I want to invest. It is presumed that they came in, that they found out about the offering through that advertising, through that web page. And so they have to either now, so because that's a general solicitation, they either have to come in through the Reg CF or they have to be an accredited investor. So they can't just write you that check unless they're an accredited investor. So those are some things you need to, I think the communication thing is really the biggest factor there, because that kind of dictates a lot of who you can take capital from and how.
And I'd say that from the from the perspective of those of in the industry, the communication is probably one of the areas that's very difficult for issuers to understand because there are a lot of rules about what can be said, how it can be said, where it can be said. These are things that aren't always obvious, and it's not always intuitive as well. So that's important. You mentioned the term testing the waters, Marty, and we haven't defined that. Would you mind taking a second just to tell people what testing the waters means?
Yeah, testing the waters is basically pre-offering marketing, right? You're going out and you're telling people about the company. You're telling people, hey, we are thinking about doing this. We are thinking about raising capital through Reg CF or through Reg A. And usually in connection with that, there is a way for somebody, a potential investor, to indicate interest, to say, keep me informed. Yes, I'd be interested in investing. Sometimes they'll even go as far as, yes, I'd be interested in investing, and I would invest up to this much. So it's a way for companies, issuers, to go out and again test the waters to see what interest there is in their offering before they actually, under Reg CF or Reg A, file their Form C or their Form 1A with the SEC and actually start the process. So it's something. Initially it was only allowed for Reg A, but there was change to Reg CF, where Reg CF also allows you to test the waters now, which I think is good. But it's communication and it's general solicitation. So if you have that up, then you're basically limited yourself. You've got to go
You have to be on
with
a
one of the
pathway,
exemptions. Yeah, you've got to go
right,
with one of the exemptions that allows um, general solicitation.
to take place.
And
And
yeah, and you can't, in that situation, you can't be taking capital from non-accredited investors unless they're being put through, unless it's pursuant to the Reg CF or Reg A or something like that. So it's interesting. Anecdotally, I had a client just yesterday that they're, working with WeFunder. They've got to test the waters campaign up, and they called me and said, hey, we've got this prior investor that invested in our first couple rounds. He's going to write a check, so we need to do the paperwork for that, because they have a testing the waters for a Reg CF that they're going to do. They're raising some capital for that, and I had to talk to him and say, okay, this person's a accredited investor, luckily, but we had to kind of talk and say, listen, you can only take capital from accredited investors at this point. And he didn't understand why. He said, well, we haven't done anything yet. I said, well, you've got this web page up and you are telling people you're going to raise capital, therefore it's a general solicitation. So that
right.
was a, like real life example just yesterday of this happening.
And
Yeah.
as you mentioned, it's people can express interest. It's not something where they can take any funds at that point. So
Correct.
this is
Correct.
often it's an opportunity to build community around what you're doing and build interest before you decide whether it makes sense you're going to go live or not. So um, so when we talk about, and just to clarify from the point of uh, this webinar, as we talk about side-by-side offerings, we're really talking about concurrent offerings when people are using more than I'm sorry, concurrent offerings, concurrent exemptions, using more than one exemption at one particular time. So I just wanted to clarify that. But there are other ways that you could consider or view the term side by side. Is that right, Marty?
Correct. Yeah,
Right.
I think that yeah, so side by side, I can mean a bunch of different things. I think sometimes people think side by side and it's a sequential, right? We had a 506B and we ended it, and now we are now starting into our Reg CF, or there's some sort of overlap there. But generally, a side by side means, I think the most common that you'll see is a Reg CF, where you're targeting almost exclusively accredited or non-accredited investors. And alongside that, you'll have a 506C Reg D offering that you're funneling your accredited investors into. And there's some mechanics on how you have to do that. Sometimes if you're doing that through the platform, there's like kind of different doors they enter and different information there, not different entirely, but additional disclosures and so forth that are required under each of the exemptions. So those are the two that you typically see most. But I think that when people talk about a side-by-side offering, that's generally what they're talking about. However, it could be we've got a Reg CF and we're doing that, and the Reg CF still going, and we just also launched a Reg A.
Okay.
Something like that.
So, Sean, you talk, I mean, you're focused a lot on the execution and how these things play out, sort of, how do your issuers think about it? What's the timing that your business is really focused on advising folks on how to raise capital, and you work with them from an execution sort of standpoint, but how are they looking at this side by side? Talk a little bit about the execution side of it.
Yeah, so when a founder asks me, can I run two raises at once? They're almost thinking practically, not legally. So they're asking, can we do a CF on platform A and a 506C out to our investor network at the same time? And how do we make sure we don't oversell or something? The reality is, once your all ducks are all in a row legally, launching takes coordination, but it is doable. Of course, you need parallel legal tracks, one for the Reg CF, platform terms and offering statements and everything, and one for 506C. You'll need the private placement memo and investor agreements. You'll need really good allocation tracking for the cap table, of course. And you need clear messaging internally and externally between what goes where and what we're going to say. And if we update the pitch deck for the 506C, do we have to do whatever on WeFunder? And you do need to set all of it up in the beginning. Setting up investor audiences is the easiest thing I would say out of this whole process, because founders can just kind of get it intuitively. They know that retail investors and angel investors probably are best suited to a WeFunder or a Start Engine raise. And that a Reg D is for the accredited investors. And so that's less of a problem, but knowing where your natural market there is about as far as I would say they would go. But I would really encourage founders when they're thinking about a side-by-side offering. It is doable, but just really anticipate the operational lift. You're managing two investor bases, two different communication streams, two closing processes. Of course, at the 506C, you would need to verify accreditation that you don't need to do on a WeFunder raise. So really owning that and knowing what you're capable of as an organization is really key there.
Okay, that's great. It's very helpful. Think about it. Marty, when you're advising clients, what sort of advice do you give them? Are there any problematic pairings when they're looking at side by side, some do's and don'ts that people should know?
Yeah, and I think that Sean hit on a lot of things that there are different requirements for these. And like Sean said, if you're doing a Reg CF, you've got an offering circular, or sorry, you've got a Form C that and you might have investment documents and terms there. And then if you are also doing a 506C, then you would have a PPM, which there can be some overlap there, but it's sort of dual tracks that you've got to not only manage legally, but you've got to manage internally how you're going to keep track of that. There are some obviously pairings. 506B doesn't play nice with any of them. You hear people talk about how they're trying to do that, how they've got this, like it's password protected, and you have to, all sorts of things going on. But again, the presumption is that if you have an offering, a live offering under Reg CF up, or Reg A or 506C or anything where you're doing a general solicitation, that's how it's presumed that's how they heard about it. And so you can't have this sort of super secret private offering on the side that said, hey, well, it's just, it's my brother, he doesn't know about it, he didn't hear about it from this, he's just going to write us a check. It doesn't matter. So 506B doesn't play well with any of them. My thought is, if you go through the process to do a Reg A, you have audited financials. I sometimes hear people like, hey, we've got this Reg A, but we're going to also do this Reg D on the side. And my thought is, why? Just put, unless you think you're going to exceed the 75 million max, then that, maybe that makes sense or it would make sense at that point. But that's a high class problem. I think generally just put them in the Reg A, they're going to receive unrestricted securities and be able to theoretically trade those immediately.
And there have
And
been companies that have run Reg CF alongside of
yeah,
Reg A. Is there any, that's possible. Is there any reason
it
to
it
justify that? What's the
it's
thought behind that?
possible that I've seen that, and sometimes I had a client that did that, and it was just different terms. This was a crazy deal where they, um, so what they wanted to do is they wanted to sell, they were like a discount Amazon, Costco kind of thing, and they want to sell these membership cards. But when you bought a membership card, you also you received equity in the company.
Mhm.
So that's became a public offering. So we did register that through Reg A. So that was qualified. But then they were like, you know what? We kind of, for some people, we want to flip it where if you invest with the company, we'll give you a membership card and a free membership card. So it was like same but different. And so we did that under Reg CF. So there can be those reasons. It was just literally they were like, as they got out and talking to people, they were like, well, I actually want to invest. And like, okay, great, but we'll give you, so we can't really bring you in through this route, so we'll have to bring you in through this other route. But they were soliciting it through their website, so they had to have those two exemptions. So it's not impossible. It doesn't, but that there is some logistical issues with that they had to figure out as well.
So there's a chance for some creativity and some innovation is taking place in terms of mixing and matching and the strategic reasons why people will use simultaneous
Yeah,
uh,
absolutely.
exemptions. And so, Sean, I think you've alluded to it before, but just in terms of, what are the most attractive combinations that you are advising people on when they're raising?
Well, so in our opinion, Reg CF and 506C is the sweet spot. It You can get the retail community capital plus accredited investor capital to help fill up the round. Reg CF can do the heavy lifting with the story and the momentum for the product. It's public, it's transparent, it builds your brand. I mean, it's a win all around if you're willing to do it. And if you need to keep going, the 506C captures the serious institutional money that hears about your raise, might want a larger equity position, prefer private terms. I mean, it's all legal. The timing works, file a form for the Reg CF, then get the Reg C or the 506C going. Of course, the legal pairing just works because both of them allow general solicitation. And for institutional capital accredited investors that like to see that validation, it really can be a powerful combination between saying, oh, you got all your customers to invest, you got 1,000 customers to invest in your product or your company at this point. Yeah, I'm in. Because then they see that, oh, these people will stick around as well. I think it goes without saying, but I'll just say it. Reg CF and a 506B, this is generally not recommended. 506B does not allow general solicitation. And so being public with a Reg CF telling the world that you're raising money, I mean, it really taints the 506B raise. And so I really recommend not pairing those two things. Reg A goes without saying, it's just a bigger Reg CF, I would argue. Of course, there's more filing requirements and everything, but you can do a Reg B 506C there. But yeah, bottom line, recommend as the best case scenario, Reg CF plus 506C. They're designed to do one full stack. One allows public solicitation, the other one is accredited only, but you can again solicit. And yeah, the SEC wants founders to raise money. They really do. You just need to follow the rules.
Right. And that's good. And we've had a couple questions, and I have had a couple that were submitted in advance. But one was, why not just do a Regulation A instead of the side by side?
Oh boy.
Yeah, well, there's a number of reasons why. One is Reg A's are cost a lot more and take a lot more time. You do
And
see
I was gonna say,
we
how long
Audit
does it?
right out of the gate. Like,
Right,
yeah.
yeah,
right,
yeah,
right out of the gate, ongoing reporting, and is there a certain amount of time to get your deal qualified, which could be an issue?
3 months optimistically, 6 month realistically, 12 months
Questions from the
possibly.
SEC.
Yeah,
Yeah,
yeah.
all that.
So all of that. A lot of times people will do. We've done this with a number of our clients. They'll they'll do, it's not side by side, but they'll sequence them, right? So you do a Reg CF, like for all of the reasons Sean said. I mean, it's getting the name out there, it's getting the interest, but also they're raising the capital necessary to raising some capital so that they have that dry powder when they do the Reg A, because ultimately all of these things are, I mean, we talk about them as legal exemptions, but they're marketing, and you've got to, that's where the dollars are spent, is on
Mhm.
marketing. And so I've seen it more common where you'll sort of sequence it, where they might even do like a 506B raise, because we can do that like immediately, and that's how they capture the first few checks. And then we get going with the Reg CF, and they start building some buzz and bringing in a few investors, and then we do a Reg A, and you can, if you structure it right, you can literally convert all of those people that came in the early raise into the class of securities you offer in the Reg A, and now those early people have unrestricted security. So there's things you can do there on sequencing, but jumping right into a Reg A, I mean, if you have the capital and the time frame, and that works, especially if you're raising, if you're over 5 million, or you have just sort of a bigger plan, then that makes sense. But there are plenty of reasons not to.
So who is, as founders or entrepreneurs or issuers are considering this, who should they have at the table early for these discussions when they're mapping out? Because it sounds like this needs to be part of a strategy from the get-go. Who do you recommend they're talking to from day one or before they make the decision on how to move forward with this? Either one of you.
Obviously, the
Yeah.
securities attorney like Marty here, obviously.
Okay. Okay, so an attorney is important, maybe the intermediary, marketing team if they don't have one. Are
Marketing
they,
team, yeah.
yeah, these sort of, it's just,
It's 2026, guys. Like, you can reach out to, go to WeFunder, find somebody that raised a bunch of money. Your founders like helping other founders. Like, I would encourage anybody that's thinking about doing this to talk to people that have been in the industry and the community for years and have done this, to just ask them how, tips of the trade, and that it will either give you confidence or it will let you know that you need to get a few more ducks in the row.
what mistake would you should issuers want to avoid when they're, you want to tell them to be careful about when they're considering side-by-side offerings?
Oh boy.
I think we've said it before, but I think it's really the communication, right? I think you just have to be careful what you're saying, and um, that example I gave yesterday was like perfect, where the guy's like, "Hey, we're getting our Reg CF already up and going," and I just kind of probably said, "Well," he said something about testing the waters. I said, "Wait, is that live?" And he said, "Oh yeah, here's the site." And I went and I'm like, "Oh, they're already testing the waters, so whoever you're taking money from better be accredited at this point." So I think that's something I don't think people understand kind of how these work and um, overlap. And so I think it's important that you're, talking to the right people through the process, because you can inadvertently really easily um, blow your
Your
exemption.
exemption pathway if you're not thinking about it or staying disciplined from the
No.
start. So, guys, I want to do one more question then before we close. If you could give issuers sort of one rule of thumb to think about before they're doing it. I'll start with you, Sean. What would be the sort of one rule of thumb before they consider whichever pathway when they decide to raise money?
Do you want to advertise or do you not want to advertise? That is the bottom line. If you were willing to advertise, Reg CF and Reg B 506B or C, awesome combination. Highly recommend more. If you do not want to advertise, want to keep it close to the chest, 506B.
Okay, that's good. So, Marty, how about you?
Yeah, the question I always ask is, how much do you want to raise? How do you want to raise it? And from who? And I think those are the questions that, you always need to think about. How much are we raising? Who are we raising it from, and how? So that goes to the, do we want to advertise? Are we raising it from the crowd? Are we raising from smaller, from people we know? And then just how much, that kind of also dictates where we fall.
Right. Thank you guys. And I got a note that said I did not introduce myself because I was talking to you guys backstage as we come on. So I'm Brian Christie. I'm the vice chair of the Crowdfunding Professional Association. I'm also co-founder of the Biotech Funding Portal. We are one of the sponsors of the summit, the CfPA summit in the fall. Each of your companies, Sean and Marty, are also going to be sponsors of the summit. So for
It'll
those
be a
of you
great time.
Yeah, so those of you who want to learn more, get some great insights, meet with people in the industry, please try and make a point of coming to DC in October. We'd love to have you. And for the rest of you who can't make it, please stay connected, join the association, cfpa.org or crowdfundingecosystem.com to engage with the organization. A whole lot of people with a lot of experience are involved with trying to advance the industry. So we'd love to have you, even if you're just learning, if you're experienced hand, love to have you engage. So thank you again to our panelists today. You guys are great. This is something that every founder should sort of listen to as they're making their own decisions before they pick their path forward. And so great for you guys to share your expertise today. And we look forward to seeing you all in October.
Awesome.
Thanks again, Brian.
Thanks so much, Brian.
Okay, great.
See you, Marty.
Bye, everyone.
Thanks,
Okay.
you guys.
Bye-bye.